Friends, today we're going to explore a monumental shift happening in our world, what we call the Great Counterbalance. Imagine two enormous forces pushing and pulling on our global economy: a significant headwind and a powerful tailwind. The headwind is the slowing of population growth, meaning fewer hands in the workforce over time. But, thankfully, there's a strong tailwind: the incredible acceleration of technology, especially generative AI and infrastructure innovation. This isn't just about computers, it's about how these forces will redefine everything from global power to where we wisely choose to invest our hard-earned savings for ourselves and for future generations. It's about planning for a robust financial future in a changing world. So, how do these divergent forces, demographics, technology, and geopolitics, converge to shape our markets? Think of it this way: demographics, that's the drag. Our world population is aging, and that leads to what we call the silver economy. This reality means we need to think differently about consumer patterns and labor. Then there's technology, the lift. Artificial intelligence is quickly becoming essential, helping to offset labor shortages and moving from just data centers into our real economy, like healthcare and logistics. Finally, geopolitics, the friction. While global tensions exist, the idea of a massive asset meltdown is, frankly, overstated. Markets are resilient, they adapt through global capital flows and a slower than predicted decumulation of wealth. Understanding these forces helps us make wiser investment decisions for our future. Let's look at the foundational demographic shift. The era of rapid, exponential population growth is indeed coming to an end. United Nations projections show our global population peaking around 10.3 billion by 2084, and then gently leveling off. But what's truly significant is the inversion by 2100. In 1950, most of humanity lived in upper middle to high-income countries. By 2100, the picture flips dramatically, with nearly 68% living in lower middle to low-income countries. This fundamental shift, alongside global fertility rates dropping below replacement levels by 2050, means we're looking at a profoundly different world for future generations. Now, let's talk about something many of us might have heard whispers about: the asset meltdown hypothesis. The fear is that as baby boomers retire, they'll all start selling off their investments, causing markets to crash. But let's take a calm, thoughtful look at the reality. The evidence suggests this fear is actually quite overstated. For one, studies by institutions like the Federal Reserve indicate only a very modest impact on returns, perhaps 30 to 100 basis points. More importantly, many of us, especially those with substantial assets, plan to keep that wealth not just for our own longevity, but also to leave a legacy for our children and grandchildren. This bequest motive means we're not just liquidating everything. And remember, markets are smart, they tend to look ahead, so many of these known demographic trends are likely already factored into today's prices. So, rest assured, the market impact is far less dramatic than some headlines might suggest. So, how do we counterbalance the demographic drag we just discussed? Artificial intelligence is emerging as the powerful macroeconomic counterweight. Where working-age population growth is slowing, AI-driven productivity is stepping in. This isn't just theory, it's a necessity. We've seen the Nasdaq 100, heavily weighted with tech innovators, deliver an annualized return of 16% between 2007 and 2025, significantly outpacing the S&P 500. This is because AI is broadening its scope, moving beyond just tech giants into the real economy, impacting sectors like healthcare and logistics. Companies investing heavily in R&D are creating resilience, ensuring our economy can thrive even with labor shortages. It's about smart innovation securing our future. At the very core of this technological revolution are data centers, truly the engine room of our digital world. The United States is a global leader, hosting approximately 51% of all global data centers, and an astonishing 95% of the world's internet traffic flows through these critical nodes. As the World Economic Forum wisely put it, once viewed as back-end infrastructure, data centers have evolved into strategic assets. In a crisis, controlling domestic data storage could be as important as controlling energy supplies. This means they are not just infrastructure, they are a matter of national and economic security, fundamental to how our modern world operates. Moving to editorial financial futurism, let's consider the concept of digital sovereignty and the splinternet. We're seeing a geopolitical division, almost a digital iron curtain, emerging between different spheres, such as the US and Western allies, and regions aligned with China's digital Silk Road. This has serious implications, including potential tech decoupling where incompatible standards could arise, export controls that restrict advanced AI chips, and data nationalism, which requires data to be processed domestically to avoid surveillance. These are key risks that could affect global trade and technological progress, impacting the interconnected world our grandchildren will inherit. Let's continue with our editorial financial futurism and delve into the inversion of global demographics. Looking at projected population shifts from 1950 to 2100 reveals profound changes in global influence. By 2100, India is set to overtake China as the most populous nation, while China's population is projected to significantly decrease. We'll also see the remarkable rise of Africa, with 5 of the top 10 most populous nations being African. Conversely, Europe is projected to fade from the top 15 by 2100. These shifts aren't just numbers, they represent fundamental changes in global markets, resources, and geopolitical power, offering new opportunities and challenges for the future. Now, let's talk about a vital solution to demographic stagnation: immigration. This chart clearly illustrates the impact. Without migration, the U.S. population is projected to shrink significantly by 2100. However, with robust immigration, our population continues to grow and thrive. Migration acts as a critical safety valve, injecting working-age taxpayers into aging systems, which helps support our social security and economic vitality. The United States is uniquely positioned to benefit from this, more so than many homogeneous societies, ensuring a more vibrant and prosperous future for us all. As we move through retirement, our financial priorities naturally shift. We go from a period of accumulation, actively growing our wealth, perhaps through growth stocks, to one of preservation and decumulation. This means ensuring our nest egg lasts, provides reliable income, and covers our needs. This is precisely why we're seeing a significant rise in the demand for annuities and what we call longevity insurance. This chart shows that those aged 65 and over, who currently hold 50% of annuity contracts, are projected to hold 64% by 2040. These products are designed to give us peace of mind, managing the risk of outliving our savings and ensuring a steady income stream for years to come, especially as healthcare costs continue to be a consideration. It's about smart planning for a long and fulfilling retirement. It's truly remarkable how innovation decouples market value from population trends. Even with demographic shifts, innovation continues to drive significant market returns. Looking at annualized returns from 2008 to 2025, the Nasdaq 100, a bellwether for innovation, has significantly outperformed the S&P 500, delivering a 16% annualized return compared to 11%. This innovation premium is a testament to its resilience, outperforming the S&P 500 in 14 of the last 18 years. Much of this is due to the AI shield, with about 30% exposure to software and digital services, sectors less reliant on physical labor or tariffs. And importantly, this earnings growth isn't just in tech, it's broadening into vital sectors like industrials and healthcare, offering diverse investment opportunities. Continuing our editorial financial futurism, let's consider global capital flows as the equalizer. This mechanism helps balance economic disparities across the world. Think of it: nations with older populations and high savings, like Germany, the U.S., and Japan, accumulate a savings glut. This capital then seeks higher returns, migrating to younger, growth nations like India and Vietnam. The result is fascinating. The negative impact of aging on returns in developed nations is significantly dampened by this global integration of capital. It's a testament to how interconnected our world is, helping to stabilize markets and create opportunities for investment across borders. Let's peer into the future with our 3 scenarios for the year 2100. The most likely path we foresee is the rebalanced era. Here, AI productivity effectively offsets the challenges of aging populations, global capital flows continue to equalize returns, and markets evolve towards efficient preservation. However, we must also consider less favorable paths. One is stagnation, where demographics overwhelm technology, leading to asset deflation and a Japanese disease that goes global. The other is fragmentation, characterized by tech decoupling, migration bans, stagnation, and high inflation. Our goal, of course, is to navigate toward the rebalanced era through prudent planning and strategic action. To ensure we navigate this transition wisely, here are our strategic imperatives. First, the productivity play: invest in companies that are replacing labor with software, particularly in the real economy sectors like industrials and healthcare, not just pure hardware. Second, consider digital borders. We need to monitor data sovereignty and align infrastructure investments with geopolitically friendly blocs to ensure security. Third, the care economy, healthcare and annuities are not just defensive plays, they are secular growth engines driven by an aging population's needs and desires for longevity. And finally, U.S. demographics. The U.S. remains the youngest G7 nation, largely thanks to immigration. Betting on the U.S. is betting on continued vitality through smart migration policies. These are key areas for thoughtful consideration in your long-term planning. To ensure you have full confidence in the insights shared today, here are our sources and references. This presentation is built upon robust research from highly respected institutions, including the United Nations, the Federal Reserve Bank of Kansas City, the OECD, and the World Economic Forum, among others. We believe in providing well-researched, credible information to help you make informed decisions for your financial future.